that's really the tilt. Dhananjay Sinha joining us, CEO and co-head of equities at Systematix Group. Good time to have this conversation, Dhananjay, much awaited. Let me
Good
first start
morning.
off by getting a sense. What could the outperformers of Q1 be as per what you are really penciling in terms of the earnings print?
So I think I think there has been a lingering effect of the GST cut last year, and there has been a sort of a bump up as far as the volume growth for auto sector is concerned. So we have seen sort of double-digit growth for PVs, two-wheelers, etc. So that might actually linger on to the first quarter this year as well. So that is one thing. The second, I would say that there can be upside surprises for select consumer names, especially in the context that last year same quarter was a weak quarter, and there is a base effect that is coming up. So in terms of top line growth, select consumer names, there can be somewhat better growth. However, we think that the pricing aspect needs to be looked at more closely. So that is another thing. Third, I would say with respect to the banking sector, there has been a positive surprise with respect to the total loan growth, and that is something that might actually drive the operating leverage of some of the banking sector. However, we also know that there has been a lagging effect of the deposit growth, as a result of which there is certain issue with respect to transmission of operating leverage to profit growth. So, it needs to be looked at selectively within the banking sector as well. And of course, the insurance sector is something that is doing a good business. So I think that's broadly what I would say is the context from upside surprises. But I would say on an aggregate basis, we need to really look at the overall top line growth. The top line growth is likely to be in mid-single digit, and there has been a sort of increase in material cost and margin pressure generally across companies. So I would say that what needs to be watched is what is the overall top line growth on an aggregate basis. And we think that there can be a downside surprise as far as the margins are concerned. So broadly, on an aggregate basis, operating profit margins might contract by 100-150 basis points.
Dhananjay, hi, morning. I was looking at the GST numbers for the month of May, which is reported in June. The GST growth was roughly around 14 odd %, which is coming in, which is fairly because June is also seemed to be a very good month. Do you think that we'll end up in early teens growth in Q1 from a top line point of view?
No, I didn't get what you're talking about. GST growth or what?
GST numbers, which give you an indication of the top lines.
So I think there has been an increase in, there's a mix of domestic and global businesses. So a lot of what you see as GST accretion has come from higher imports, and that's largely because commodity prices had gone up, oil prices had gone up. So I think if you extract that, it doesn't really reflect in the domestic buoyancy as much. So I would say that if you extract the IGST part of it, the underlying is not so strong.
Margins point of view, do you see, because you see a lot of volatility during the quarter with respect to crude and crude derivatives, the margins could be under pressure for many of the consumption based in the companies?
Yes, so I think you have also had a sort of a weakening rupee as well. So the effect of the rupee weakness and the rise in crude prices is likely to have an impact on the overall cost scenario. As a result of which, as I said, broadly we are expecting about 100-150 basis point reduction in the margins. And I would say that more than just the cost, you need to really look at whether the top line growth is matching. And I think broad view that we are getting from various analysts is that it is going to be a sort of a 5% growth as far as top line growth, top line of non-finance companies are concerned. Also, we have done a lot of channel checks at the ground level. We have looked at a lot of consumer companies, including FMCG, value retail, alcohol beverages, etc. I would say that the company and ACs, etc. While companies had taken price increases because of the rising cost, companies are finding it difficult to really sustain that, and they are not able to really pass on the entire cost to the end product. So I would say that what would sort of reflect in this quarter numbers is that while the price increases happen, it is not really translating into as much of margin expansion. So broadly, I would say that we'll need to see in the coming quarters whether the easing of commodity prices and crude prices is translating into betterment or not. But I think this particular quarter is going to be on the weaker side compared to the fourth quarter last year.
And, Dhananjay, of course, the reaction will be to the numbers itself, but also the commentary, right? So, yes, you
Yes.
may have one soft quarter, but thereafter, if at all there is an indication that Q2 is probably much better than Q1 from
Yes.
a commentary standpoint and a profitability standpoint, you could well see very limited impact on stock prices.
So I think you're right. I think guidance of the company in terms of how it pans out going forward will be very important. I would say that companies are likely to say that reduction in the crude oil prices are expected to reduce the cost pressure going forward. However, I would say that can be a sort of a positive aspect of various commentaries that one expects, but I would say that we need to really look at what is the overall demand scenario that pans out. That's not what the management can actually guide for in a significant way. I would say that given the survey that we have done of households, both for the urban and the rural segment, I would say that rural appears to be on the weaker side, with real wages being flattish or negative. I would say that rural wage growth has decelerated to something like a 4% on a month-on-month basis for the months of February, March. On an annualized basis, it's translating into something like 2%. And you have an El Nino effect also coming up in the coming quarter. So I think that on the rural side, the demand appears to be on the weak side. With respect to the urban side, I would say a good amount of impact has been showing up with respect to the GST reduction and the volume growth, especially for the premium products and auto segments. However, if you look at the high frequency monthly data, we find that the volumes for auto segment it started to wane. So we'll need to see how also the fact that if you look at the banking sector data, there has been a significant support coming from leverage consumption, especially with respect to autos. We'll need to see whether all these things will translate, and the good thing to really look at is the wage growth and salary growth that for overall corporate India actually shows in their Q1 numbers. In the Q4 number, we have seen that decelerating to something like 6%. On an 8-quarter basis, about 7%, which is lowest since 2014. So we need to see whether, from a demand standpoint, will the urban demand hold up with respect to compensation growth, and whether we can continue to push demand through leverage spending through the banking sector or not.
Dhananjay, one sector which will be in focus this week or towards the end of the week is the IT sector.
Yes.
What is your estimate on how the IT is going to fare? They've been, battered a lot in the last one quarter. From an earnings point of view, is there any tailwind that they have aside of the currency which is there?
So of course, depreciating rupee has an impact in terms of revenue, rupee INR revenue, and that has an impact on the overall performance. But I think it's only a marginal aspect, but what needs to be understood is whether the fact that the IT sector has been underperforming for the last 5 years or so. I think there was a significant bump up post the COVID because of the digitization boom immediately after COVID. But since then, it has actually remained fairly flattish. I think the key concern the IT sector is being facing is with respect to the AI and GCC expansion. There has been a significant expansion in capital outlay by US companies, estimated at $700 billion for current calendar year and $800 billion next year. I think there are sort of more indications that are coming that companies are trying to do more of captive investments, and that's not translating into outsourcing to Indian companies. And there is a certain amount of competition that is arising with respect to the AI and the outsourcing space. So I think IT companies have been lacking on the revenue side. And I would say that we are expecting a modest revenue growth for this quarter, ranging between -1% to plus 5%. But I think on an average, it's likely to be fairly muted. There can be a sort of increase in guidance from Infosys, as we have mentioned, to roughly about 2 to 3.5%. So, and that's translating from the acquisition that they have made. So that is there can be a positive surprise from Infosys, largely related to inorganic growth.
So by the end of the quarter, Dhananjay, which are the sectors
Yeah.
that's going to drive earnings for, say, the Nifty, and which are the sectors
So I
which will be a
think
drag?
So I would say that what if you look at the Nifty companies, I would say banking sector appears to be showing a kind of increased operating leverage, but we'll need to see whether, I mean, the expectation is pretty strong. Overall, Nifty earnings growth from a consensus standpoint is in the region of 12 to 15%. But I would say that it's on the higher side. It's likely to be moderated going forward. But I think a large part of this growth is expected from the banking sector, where the credit growth has been pretty strong. We'll need to see whether that translates in the context where the cost of fund increases, and there is a huge dependence on non-deposit liabilities, which is high-cost liability. So I think the competitive pressure for the banking sector is there, despite the fact that there is a positive surprise as far as the overall credit demand is concerned. I would say IT sector will continue to be on the moderating side. I don't expect too much of growth from there. As far as auto is concerned, it's likely that as commodity prices come down, there can be some margin expansion in the coming quarters. Even if the volume growth sort of moderates or from here on, I would say the margin can be somewhat positive. I would say from a consumer standpoint, again, it is going to be very selective. I don't see demand being very strong. I would say margin is again something that will need to be seen very selectively. There has been a pressure on oil and gas because of rising crude prices, especially for the OMCs. There can be some easing out there. I would say metal has done very well. I would say there can be a sort of a moderation going forward because of the easing of the commodity prices. I don't see very strong numbers coming from cement, for instance. There has been increase in prices ahead of the monsoon season. But I would say that there has been certain moderation as far as the real estate sector is concerned, which is a significant contributor to the overall demand context for the cement sector. So I think those are the broad contours I have in mind for the earnings outlook.
Okay, Dhananjay, thank you so much for coming in, giving us that perspective. Really, really appreciate it.
Thank you.
Okay, what we'll do is slip into a very short break, come back with more. Stay with us. We'll have a corporate conversation lined up for you on the other side.